Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Aduro Clean Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at the short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So imagine holding a stock in your portfolio that just reported literally $0 in quarterly revenue.
Right.
Yet behind the scenes, institutional investors are quietly fighting to accumulate as many shares as possible.
Yeah, it's wild.
It's the exact paradox we are exploring today, because we really need to unpack what is happening right now with Aduro Clean Technologies. There's this fascinating tension at the heart of the company. On one hand, you have a pre-revenue business, but on the other hand, they're sitting on a massive cash pile of over $39 million with almost no debt. So I guess the question for you is, why is the smart money flowing into a company that isn't actually making any money yet?
Well, because the smart money isn't looking at what the company sold last quarter. I mean, they are looking at the massive regulatory shifts happening globally, right?
Okay.
And they're betting that this specific company is currently crossing what we in the industry call the commercial chasm.
The valley of death, basically.
Exactly, the valley of death. It's that, treacherous phase where a company has proven their brilliant science works perfectly on a small laboratory bench, but...
And now they have to prove it.
Yeah, they have to prove it can run continuously in a massive industrial scale plant. And honestly, a lot of great science projects die in that chasm because they just run out of capital.
Right.
But Aduro is bridging that gap right now. They're transforming from a bench-scale science project into a validated industrial-scale clean tech platform.
All right, let's move into the wealth building context. Because to really understand why institutions are buying a pre-revenue stock, we have to zoom out and look at the macro forces at play here.
Exactly. You have to look at this stock through a much wider lens. This is not a short-term flip where you jump in and out for a quick 5%.
No, definitely not.
It's a structural play on inescapable regulatory shifts. Think about the European Union right now. They are rolling out incredibly strict packaging waste regulations.
Yeah.
They're essentially making it illegal for chemical and plastics manufacturers to keep operating the way they have for the last 50 years. And it's not just Europe either. If you look at the U.S. at the state level, we are seeing extended producer responsibility laws passing rapidly.
Let's actually pause and explain that, because extended producer responsibility, or EPR, is a massive catalyst on its own.
Oh, absolutely.
Basically, these laws say that if a company manufactures a plastic bottle, they are financially responsible for its entire life cycle, including its end-of-life disposal. They're effectively getting taxed if they don't secure recycled circular feedstocks.
Precisely. These massive chemical manufacturers are desperate right now. They have to find ways to reuse waste plastics to meet these quotas, or they literally lose access to massive markets.
Wow.
Yeah, they have no choice but to comply.
But the problem, and this is where it gets really interesting, is that the current methods for recycling these plastics are, well, they're terrible.
They really are.
When I look at Aduro's proprietary tech, which they call Hydrochemolytic Technology, I think about how it fundamentally disrupts the old way of doing things. The traditional recycling method is called pyrolysis.
Right.
And pyrolysis is essentially brute force. It's like trying to open a locked door with dynamite.
That's a great analogy.
Right. It uses extreme energy-heavy heat to melt and break down plastics. It's expensive, it creates toxic emissions, and worse, it can't handle mixed or dirty plastics.
Yeah.
If a plastic wrapper has food residue on it, the dynamite approach just buns it into toxic ash.
That is a brilliant way to visualize it. And Aduro's technology is the complete opposite of dynamite. Instead of brute force, it's like a master key that slides in and unlocks the chemical bonds cleanly. And here's how they actually do it. They use water and relatively low temperatures. Normally, we think of water as completely inert, right?
Yeah, exactly.
But under Aduro-specific conditions, water actually acts as a chemical agent. It donates hydrogen atoms to the broken carbon chains of the plastic.
Oh, interesting.
Yeah, and by Capping those chains with hydrogen, it prevents them from recombining into toxic sludge. It basically acts as chemical scissors, cutting complex mixed feedstocks down to their most valuable base chemicals, all without combustion.
Wow.
So competitors simply cannot process contaminated materials economically, but Aduro's master key just thrives on it.
And because no combustion is involved, you have drastically lower energy costs and lower emissions.
Yes.
So it's a cleaner process all around. But if we're being intellectually honest here, a great master key doesn't mean anything if the business itself isn't structurally sound.
Fair point.
Now let's look at the fundamentals, because this is where my cautious analytical side really starts flashing warning lights.
Okay, lay it out.
If you're listening to this right now, your alarm bells are probably ringing too, and we have to be upfront with you about the stark realities of this balance sheet. The company is fundamentally loss-making right now.
Right.
If you look at their year-to-date revenue for the third quarter of fiscal year 2026, it was just over $167,000. That is microscopic for a publicly traded company.
It is.
And the most recent quarter, zero. Literally nil. On top of that, the operating losses have widened to over $14.4 million year-to-date. So when I see a company bleeding $14 million with zero quarterly revenue, my immediate instinct is to step back.
I hear that, and it's definitely the right instinct to have. But we have to look under the hood to see why the revenue was zero and what exactly makes up that $14 million loss.
Okay.
It wasn't because they lost clients or the product failed. It's because management deliberately shifted focus.
How so?
They took their engineers and resources away from small-scale customer engagement programs, which were the things generating those tiny bits of revenue, and went all in on commercial scale-up activities.
Oh, I see.
Yeah. So that operating loss isn't just wasted money, it's the cost of specialized engineering salaries, raw materials for testing, and heavy R&D. They are choosing to forego pennies today to build the infrastructure for millions tomorrow.
Right.
But you can only make that kind of strategic pivot if your balance sheet can handle the burn. And Aduro's balance sheet has been completely transformed.
Wait, let me stop you there. We talked about a 467% surge in their cash position, bringing them to $39.42 million.
Yeah.
But if they are pre-revenue, where exactly did that cash injection come from? Was it purely from their recent public offering? And what does that mean for the people already holding the stock?
Yes, it came from a U.S. public offering. And while public offerings do introduce dilution, meaning the total pie gets divided into more slices, that capital raise was an absolute necessity.
Right, they needed it.
Exactly. It gives them a massive multi-year runway. They aren't constantly worried about keeping the lights on anymore. And they aren't just hoarding that cash in a bank account either. Property and equipment saw a 99% increase.
Oh, wow.
Yeah, that is the physical manifestation of them building their next-generation process pilot plant. That is the bridge over the commercial chasm being built in real time.
I will concede that the cash gives them the breathing room they desperately need to finish the pilot plant. But what really caught my analytical eye wasn't just the cash, it's the expansion of their intellectual property moat.
Oh, absolutely.
You don't just want a company to have a lead, you want them to have a fortress around that lid.
Yeah.
In April 2026, they filed a patent application that fundamentally expands their total addressable market. They took this water-based technology, which was originally focused on waste plastics, and proved it can upgrade highly paraffinic crude oils.
And that is a monumental shift. For context, highly paraffinic crude oil is essentially oil with a very high wax content.
Right. And wax is a massive headache for the oil industry. It solidifies at room temperature, which means pipelines get clogged unless they are constantly heated, costing millions in energy.
Exactly. Refineries hate it.
But if Aduro's low-temperature water tech can act as a master key to cleanly remove that wax at the wellhead while preserving the quality of the underlying oil, that completely changes the game.
Yeah, it really does.
We're talking about a leap into a completely different league of revenue potential.
That brings us to the catalyst timeline, because expanding a patent is a brilliant strategic move, but intellectual property on a piece of paper doesn't pay the bills today.
Right.
As an investor, you're probably wondering what is actually going to move the needle on this stock in the near term. Over the next 3 months, there are 2 major events you need to circle on your calendar.
Okay, what are they?
First, we have the LD Micro Invitational X60th happening in mid-May. Specifically, CEO Ofer Vicus is presenting on May 19th. That is a major visibility event.
Mm-hmm.
When you have a complex scientific story like this, getting in front of institutional investors to explain that transition from lab to commercial scale is vital. And then we look toward mid-July for earnings.
And to be completely clear with you, we aren't looking at the July earnings for a sudden massive spike in sales.
Right.
Nobody is expecting them to suddenly announce $10 million in revenue. That's not the play here.
No, absolutely not. The market expects those earnings to reveal continuous flow operating data from that new pilot plant.
Which is a huge technical milestone.
Yeah.
Because batch processing, where you put material in, run the reaction, clean it out, and start over, is relatively easy.
Yeah.
Continuous flow means the machine runs 24/7 without clogging.
Exactly. They are running the feedstock through the system right now. When they release data proving that the tech works on real-world industrial scales in a continuous flow, that is the ultimate de-risking event.
I'm also watching their personnel moves very closely, because sometimes who a company hires tells you infinitely more than their press releases.
Oh, for sure.
They recently hired Scott Smith, a 25-year oil and gas industry veteran. He spent 17 years at Cenovus Energy, and he has deep ties to the Canadian Crude Quality Technical Association.
Mm-hmm.
You don't bring in a heavy hitter like that just to manage a lab. This has sparked some very intriguing, albeit unconfirmed, market rumors.
Oh, yeah, the rumors are flying.
Right. Like, is this hire pointing toward a potential joint development agreement with a major Canadian oil sands producer? If a giant producer decides to partner with Aduro to deploy this technology for upgrading their waxy bitumen, that alters the valuation model overnight.
It absolutely does. And if you watch the trading activity, the market is already starting to price in some of that anticipation.
Now let's pivot to the chart, because the technicals here are telling a story of their own. Let's look at the price action and momentum.
Okay.
The stock recently opened at $14.01. From a structural standpoint, it is holding firmly above both its 50-day moving average, which is at $11.21, and its 200-day moving average at $12.05.
Mm-hmm.
When a stock is trading comfortably above those key averages, it indicates sustained underlying bullish momentum.
Yeah, definitely.
Furthermore, it's trading much closer to its 52-week high of $17.66 than its low of $5.40.
Yeah.
What this tells me analytically is that this stock is not just bouncing along the bottom trying to find support, it is in a breakout discovery phase. The market is actively trying to figure out exactly how to price the potential of this technology.
But you have to understand that part of that discovery phase is extreme volatility. The momentum dynamics here are intense. I mean, the stock has a beta of 3.15.
To put that beta in perspective for you, if the broader market takes a single step, this stock is taking 3 massive leaps in either direction. The volatility is not for the faint of heart.
Exactly. We saw a 20% rally following just the announcement that they would be participating in that April 30th conference.
Whoa.
That shows you there is a massive appetite from speculative and institutional buyers waiting for visibility events.
But it's a double-edged sword.
Yeah.
We also see these muted pullbacks after they release actually constructive operational updates. When they announced the paraffinic crude milestone or permitting contracts, the stock actually dropped 2 to 4%.
Right.
What that synthesizes into is a classic buy the rumor, sell the news dynamic.
Oh.
The market gets excited, bids it up, and then when the actual news hits, day traders take their profits.
Yeah.
The market is essentially holding its breath. They are waiting for the ultimate commercial trigger, the actual first-of-a-kind facility generating licensing revenue to sustain a true long-term breakout.
So what does market sentiment look like? Because despite that day-to-day whiplash in the stock price, the broader narrative among professionals is definitely shifting from interesting research project to execution phase.
Yeah.
And you see that reflected clearly in the recent analyst actions. Ladenburg Thalmann just upgraded them to a strong buy.
Nice.
D. Boral Capital reaffirmed their buy rating, and they put a massive $46 price target on it.
Well, 46.
Yeah. And H.C. Wainwright initiated coverage with a buy and a $22 target. When you see multiple analysts putting targets that high above current trading levels, it shows profound confidence in the fundamental shift of the business model. And it's not just talk either. We are seeing heavy institutional accumulation.
Mm-hmm.
DGS Capital Management, for instance, just increased their holdings by over 67% in a single quarter.
But I always have to provide the counter perspective. Because no stock is universally loved, and if you're putting your money on the line, you need to know exactly why the bears are betting against it. Not everyone is convinced here.
Fair enough.
Weiss Ratings maintains a sell on the stock, specifically a D rating. Their argument is deeply grounded in traditional valuation metrics. They look at a market cap of over $400 million for a company that is not yet generating steady revenue. and they conclude it is severely overvalued. If you're listening right now, that $400 million price tag for zero quarterly revenue sounds like a massive red flag.
Yeah, it does.
And from a purely historical, cash flow-based perspective, the bears aren't wrong to be skeptical. Valuing a pre-revenue tech company is always an exercise in pricing future potential, not current reality.
Now let's talk about the risks, because you have to understand exactly what could go wrong before you consider taking a position.
The ultimate execution risk here is scale-up. As we mentioned earlier, the transition from lab to commercial scale is the graveyard of clean tech. What works perfectly in a pristine bench-scale lab environment can fail spectacularly when you try to run thousands of gallons of dirty mixed plastic feedstock through industrial pipes.
Right, the physics change.
Exactly, the thermodynamics change. And remember, they have a negative adjusted EBITDA of over $8.3 million. They are currently building a first-of-a-kind facility in the Netherlands. If that facility faces severe permitting delays, which happens all the time with European industrial projects, or if the construction hits snags, the company will continue to burn through cash.
Yeah.
If they burn through that $39 million runway before they secure commercial licensing revenue, they will be forced to go back to the market to raise more capital. And that means diluting the shares of everyone holding the stock today. The slice of the pie you bought just gets smaller. That is the hard, cold risk you are taking.
Those are incredibly valid risks, but we also have to look at the mitigations management currently has in place. They aren't flying blind here. To address the permitting risk in the Netherlands, they engaged Ebert HR, an outside firm specialized in exactly this kind of regulatory navigation at the Chemolytic Technologies Inc.
Oh, so they're outsourcing it.
Right. They are outsourcing the bureaucratic headache to local experts. And regarding the scale-up risk, remember that they recently graduated from the Shell Game Changer program.
Right.
That program specifically proved that this technology works on standard, readily available industrial equipment under continuous operation.
Okay.
They aren't trying to invent new physics or build custom, never-before-seen machines. They're applying their unique chemistry to existing industrial infrastructure. And that $39 million cash pile, it buys them the most valuable asset a pre-revenue company can have, which is time. It gives them the runway to execute their vision without the immediate looming threat of shareholder dilution.
So with everything on the table, what's the final verdict?
Based on the research and the sum of all these moving parts, the official bullish score comes in at an 8 out of 10. The core thesis here is a massive industrial transformation. Aduro is evolving from a niche, single-use plastics recycler into a ubiquitous hydrocarbon upgrading platform.
Yeah.
When you look at the total addressable market, it is staggering. We mentioned the patent expansion into paraffinic crudes earlier. Those waxy crudes represent up to 1/3 of global crude production. That is a colossal market.
It really is.
They have a fortress balance sheet, elite oil and gas industry talent joining the ranks, and a clear, de-risked pathway to high-margin licensing revenue. The upside here is highly asymmetric.
But we have to define the investment horizon clearly for you. This is not a trade for next month's rent. If you are entering this position, you need to view it as a multi-year hold, realistically looking at a 24 to 36-month timeline.
Definitely.
You are holding to capture the commissioning of that first-of-a-kind facility, the initial delivery of product to major partners, and the formalization of their licensing business model. And I'll leave you with this final provocative thought. We all say we want to invest in the next major industrial revolution before the crowd gets there.
Right.
We all want to buy the master key while everyone else is still using dynamite. But do you actually have the psychological patience to hold a high-beta, highly volatile stock through the pre-revenue turbulence to see that vision become a reality? It's easy to buy the narrative on a talk. It's much harder to stomach the execution phase in your portfolio. Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.